Federal Reserve announced another interest rate hike yesterday in the latest effort to tame soaring inflation. NBC News correspondent Emily Aketa has details.
In the Fed's fight to bring down inflation, Chairman Jerome Powell acknowledged there will be pain.
Higher interest rates, slower growth, and a softening labor market are all painful for the public that we serve.
Small business owner Anika Hobbs is already feeling it.
Where will you have to make cutbacks?
Yeah, I mean, some of the cutbacks that I've been thinking about is staff hours. Payroll is always one of those things that you can manage, but then that also is a huge pinch on me.
With the central bank raising interest rates for the 5th time in a row.
When you ring these in and you type in that final.
The owner of boutique Nubian Human has to press pause on her expansion plans.
Because we're paying more into debt rather than being able to take that money and put it into hiring more people or expanding into a new store.
The Fed's move is an effort to curb consumer demand and in turn cool inflation, with prices 8.3% higher in August than they were a year ago. But Powell's challenge is the balancing act of bringing prices down without triggering a recession. The Fed anticipating that unemployment will rise from current levels of 3.7% to 4.4% at the end of next year.
We have to get supply and demand back into alignment, and the way we do that is by slowing the economy.
Something that will be felt by everyone. When the Fed raises interest rates, borrowing money becomes more expensive, impacting car payments, business loans, credit card debt, and mortgage rates, which have now reached their highest level since 2008.
Emily Aketa reporting there. Let's bring in former Treasury official and Morning Joe economic analyst Steve Rattner. Steve, good morning. So you called this one 3/4 of a basis point and more to come. How long is this going to go on for the Fed? How long will they have to continue to raise rates?
Well, Willie, that's a subject, or a matter that has to evolve over time. The Fed's favorite phrase is to say they're data dependent, meaning they look at each piece of data and evaluate it from there. But if you look at where the Fed's so-called dot plot, what their projecting rates are going to be, and if you look at where the market's projecting rates to be, we're talking about a Fed rate that is well over 4% in all likelihood, and I think that is pretty much of a minimum, and that implies several more large rate hikes from here to get there, and obviously will have commensurate effects in mortgage markets and consumer loan markets and all the places that interest rates very directly affect consumers.
And so let's look at why we're here with your charts. In the first one, you look at the economic outlook put out there by the Fed, where we are now and where it looks like we're going.
Yeah, 4 times a year, the Fed tells us where we think we're going. And what's interesting here is that if you take their December and June and September projections and you line them up, you can see that where the Fed thinks we're going has become more worrisome over time. As we've talked about, the Fed has been behind the curve on the economy and on inflation. They have been far more optimistic than many private forecasters, and now you can see them trying to come back to where the world actually is. And so you can see they've taken their inflation up very substantially. I should note they use a somewhat different measure of inflation, so you won't see 8% there, but it's consistent with what the CPI, which is the other measure, shows. You can see the GDP has come down dramatically. At the beginning of the year, the Fed thought we could have a 4% growth rate this year. We will be lucky if we have a positive growth rate this year. It's possible that the growth rate this year could end up negative. And you see the unemployment modestly having to rise. The words that sometimes aren't spoken about the Fed is that the only way to get inflation down is to reduce demand, reduce economic activity. It does mean fewer jobs, and it means more people spending less money out there, and that's the job of the Fed and the job of the higher interest rates.
You started at the top of the segment, Steve, to speak to the second chart about exactly how high these rates must go. Let's take a look at the chart and walk us through it.
Sure. Well, the first thing you can see is on the 2 sets of straight dashed lines. Those are the Fed projections issued at different times. The one they issued in June, just 3 months ago, and the one they issued yesterday. And you can see that the Fed's own expectations for interest rates have jumped up dramatically just in that very short period of time. And it now sees inflation peaking at over 4% in 2023 interest rates peaking at over 4% in 2023 before starting to head down. And then you can see, interestingly, that curvy line, that's what the market thinks is going to happen. And the market has been consistently more optimistic than the Fed about what it thought was likely to happen. Although at the moment it thinks that rates will be a bit higher than the Fed for a short period of time, but then you see the market thinks it's turning down. So you have a bit of a disconnect here. The market for a long time was more hawkish or negative than the Fed, and now they're somewhat more positive. But whichever way you choose to look at this, we're clearly looking at base rates over 4%, which means that the mortgage rate, which is now over 6%, a recent record high, is likely to keep going up.
And Steve, let's turn to chart number 3. Anyone who's got any money in the market or has a 401k can identify this. Rising rates stinging stocks. How bad is it, and is it going to get worse?
Yeah, so make this a little segment on news you can use in a sense. And there are many things that drive the markets, obviously economic fundamentals, company earnings, things like that. But one of the things that is, in my opinion, a very heavy driver of the market are interest rates. Because when interest rates go up, people have other places to put their money and earn a high rate of interest or a higher rate of return. When they go down to zero, as they were earlier this year, they tend to put their money in stocks, which is part of why we had that enormous bull run in stocks. And so what I simply did here was comparing for you the timing of the various Fed interest rates with what happened in the stock market. And while it's obviously not a perfect correlation, you can see that, in fact, higher interest rates are the enemy of the stock market. That little improvement in the stock market last summer reflects a moment when Powell was perceived to be saying things that were a little bit softer, a little bit less hawkish about how much interest rates had to go up. So the stock market had a little recovery, but now another dose of reality has been put in front of the stock market. Look, the big question around all of this, of course, is are we going to have a recession? How bad is it going to be? We know no way in economic science of slowing an economy other by having people buy less, which often means people having less income, which often means fewer jobs, and all that can translate into a negative GDP or a recession, as we call it. And I think the economists are not by any means unanimous, but I think a majority of economists would say that it is highly likely that sometime in the next 12 to 24 months, we will have some kind of recession if and when the Fed remains committed to bring inflation down to 2%, which Jay Powell said again yesterday was absolutely his commitment. So the timing of the economic cycle here and the timing of the election cycle here may not be ideal for the incumbents and the party in power.
Yeah, the Fed doing its part to slam on the brakes for now. Morning Joe economic analyst Steve Rattner with his world-famous chart. Steve, great to see you. Thanks so much.